Good morning. I wanted to talk a little bit about the coinsurance clause, also known as the coinsurance penalty. Many people are unclear as to what this is, how will it be applied, and what they need to look out for. Simply put, the coinsurance clause is a clause within the insurance policy contract that requires the insured, that means you, the client, to insure your property to the full replacement cost at the time of a loss. Now, when you issue the policy, presumably the loss is going to be at some point in the future. So we're not quite sure what the value or replacement cost of the property at the time of the loss. So essentially what the company is saying is the onus is on you to ascertain that you've insured your property to its full limit. If you haven't done so, then a penalty is imposed. The penalty is a simple calculation. They take what you had, meaning what you had the property insured for, divided by what you should have had, which is the required amount as per the contract, and they multiply that fraction by the loss. Basically, they give you a haircut. Now, in terms of what you should have had, that's defined in the coinsurance clause of your policy if you've got one. Oftentimes, it's 80%. So let's go through this with a simple example. Suppose somebody's got a building with a replacement cost of $100,000 at the time of a loss, with an 80% coinsurance penalty. The insurance company is saying that at the time of a loss, you are required to insure your property at a minimum of 80% of that $100,000. So you are required to insure it for a minimum of $80,000. So let's fast forward to a loss where somebody's got $50,000 worth of coverage and he had a loss of $25,000. So the uneducated consumer will look at their policy and say, hey, I've got $50,000 worth of coverage and I've only got a $25,000 loss. I'm all good. That's not the way it works. The insurance company is going to come out. They're going to review your policy and they're going to say, look, this property was valued full replacement cost at $100,000. The contract with 80% coinsurance requires you to insure it for a minimum of $80,000. You only had $50,000. So they impose the penalty that we discussed. They take what you had, which was $50,000, divided by what you should have had, minimum of $80,000, and they multiply it by the loss. So they'll multiply the $25,000 by 5/8 and give you a haircut. It's key that you insure your property to value and know what you're getting. More importantly, or almost as important, is to understand what percentage you're getting. Many consumers are completely mistaken and think it's better to have 100% replacement cost, 100% coinsurance on their policy. That's a terrible mistake. That is requiring you to insure your property to full value at the time of a loss. If not, the haircut is even more. If you could, which you probably can't, you would prefer to buy a property with a 50% coinsurance penalty. Be aware of what you're buying. If you have any further questions, give us a call, 561-287-6279.